December 12th, 2025. Gold trades near $4,300 per ounce after the Federal Reserve's rate decision 2 days ago, up roughly 63% year to date, according to multiple market sources. And the largest bank in America just revealed something they hoped nobody would notice. JPMorgan controls over 60% of all gold derivatives in the United States, $65.4 billion in notional value, while predicting gold will hit $5,000 by 2026. I'm not a financial advisor. This isn't financial advice. This is an analysis of what happens when the most powerful bank on Wall Street positions itself for something it knows is coming while telling everyone else a completely different story, based on publicly available regulatory filings, institutional forecasts, and trading patterns that reveal the quiet accumulation happening behind closed doors. Here's what you need to understand immediately. JPMorgan's commodity strategist Natasha Kaneva just told markets that gold's recent pullback is merely a healthy consolidation, that prices move too fast, that this is normal. But the bank's own derivative positions tell a radically different story. They're not selling, they're not hedging, they're positioning for the biggest precious metals move of this generation. The 60% position. Nobody's talking about JPMorgan Chase owns $65.4 billion in notional gold derivatives. That's not a typo. One bank, 60% of the entire United States gold derivative market. Let that concentration sink in for a moment. The Office of the Comptroller of the Currency's quarterly derivatives report shows this position clearly. While other major banks reduced their precious metals exposure over the past decade, JPMorgan did the opposite. Deutsche Bank exited, Bank of Nova Scotia exited, Barclays exited, Rothschild stepped back, and JPMorgan quietly absorbed their market share. But here's what makes this position extraordinary. These aren't speculative bets. These are strategic positions built systematically over years, while prices were suppressed. Money manager Stephen Lieb warned that JPMorgan's gold derivative exposure likely exceeds the entirety of the bank's assets on hand. That's not risk management, that's conviction. When a bank takes a position this concentrated, this sustained, this massive relative to its balance sheet, it's not gambling, it's front-running. Front-running central bank policy, front-running monetary debasement, front-running the structural breakdown everyone can see coming but nobody wants to acknowledge. And the timing of this accumulation is critical. JPMorgan built this position during the multi-year period when gold traded sideways between $2,000 and $2,200, when mainstream analysts called gold dead, when crypto enthusiasts proclaimed digital currencies had replaced precious metals, when the narrative said inflation was transitory and central banks had everything under control. They accumulated while sentiment was bearish, while retail investors sold, while other institutions reduced exposure. That's not luck, that's institutional knowledge of what's coming. The $5,000 forecast they're not promoting. In November 2025, JPMorgan Private Bank quietly published a forecast that should have made headlines everywhere. Gold will top $5,000 per ounce by the end of 2026. Alex Wolf, the firm's global head of macro and fixed income strategy, stated prices could reach $5,200 to $5,300. That's 25% higher than current levels. But here's the fascinating part. This forecast wasn't released through JPMorgan's main research division. It came from the private bank, the division that serves ultra-high net worth clients, the clients who get the real analysis, not the public-facing commentary designed to maintain market stability. And the reasoning behind the forecast is brutally simple. Central banks in emerging markets are diversifying away from dollar reserves at an accelerating pace. JPMorgan's own analysis shows that even a tiny reallocation drives massive price moves. If just 0.5% of foreign-held United States assets shift into gold over 4 years, that translates to $273.6 billion flowing into the metal, roughly 2,500 metric tons of additional demand. The supply of gold isn't expanding. Mine production is relatively stagnant. The 2,500 tons of new demand hitting a constrained supply creates an 18% annual return scenario that eventually pushes prices to $6,000 per ounce by 2028, when Trump's term ends. Let's be clear about what JPMorgan is saying here. They're not predicting a temporary spike. They're forecasting a structural repricing event driven by de-dollarization and reserve diversification that has already begun. The bank's strategist, Natasha Kaneva, stated it directly. This is a multi-year horizon. You have a lot of buyers and no sellers. But while JPMorgan Private Bank tells wealthy clients to position for 5,000 plus gold, what are they telling the broader market? That the recent pullback from the $4,380 high is healthy consolidation. That prices move too fast. That people are paralyzed with fear because of the rapid gains. That's the game. Accumulate while prices consolidate. Tell retail investors to be cautious. Tell institutional clients to load up. The vault dominance that reveals everything. JPMorgan doesn't just trade gold, they control the infrastructure. The bank operates the largest commercial gold vault in London, the heart of the global physical gold market. They hold custodial responsibilities for a substantial portion of exchange-traded fund gold holdings. When ETFs like GLD and IAU report physical holdings, much of that metal sits in JPMorgan vaults. This creates an extraordinary information advantage. JPMorgan sees the flows before anyone else. They know when ETFs experience inflows or outflows. They know when industrial users are building stockpiles. They know when central banks are accumulating. They see the physical market in real time, while everyone else is trading paper contracts based on delayed information. And what they're seeing right now is creating exceptional opportunities. The 2025 gold rally generated dramatic volatility in physical metal flows. Market participants rushed to capitalize on arbitrage opportunities between London and New York, resulting in substantial gold movements that tested infrastructure capacity and generated significant transaction fee revenue for vault operators. During periods of market stress, access to immediately available gold commanded premium pricing. JPMorgan's integrated platform allowed the bank to capitalize on client flow while maintaining operational efficiency during heightened activity. That's not just custody fees. That's infrastructure monopoly generating windfall profits during the exact conditions the bank's strategists say will intensify through 2026. The Wealth Management Division is expanding this infrastructure specifically to meet client demand for direct storage access. Revenue opportunities from the 50% plus price appreciation in 2025 have created incentives to build even more capacity. They're not building vaults because they think the gold rally is over. They're building because they know what's coming next. The central bank buying that validates the position. JPMorgan's bullish gold stance isn't based on technical analysis or sentiment. It's based on observing central bank behavior that cannot be hidden. Greg Shearer, JPMorgan's head of base and precious metals strategy, projects 900 tons of central bank gold purchases in 2025. Consistently high levels expected given the current macro environment. But the scale of this buying needs context. Global central bank gold holdings now amount to nearly 36,200 tons, accounting for almost 20% of official reserves. That's up from around 15% at the end of 2023. This is the fastest pace of reserve diversification in decades. And the motivations are transparent. Nations not allied with the United States have begun reducing their reserve mix away from dollars, perceiving risks of keeping reserves vulnerable to sanctions after watching what happened to Russia's frozen assets. Other governments are adding protection against higher and more volatile inflation. Over 80% of global monetary authorities expressed willingness to increase gold holdings in a recent World Gold Council survey. This isn't speculation. This is documented policy shift by sovereign institutions managing multi-trillion-dollar reserves. And JPMorgan is positioned directly in the flow. When central banks buy, they custody with major banks. When they need to move metal, they use the infrastructure controlled by institutions like JPMorgan. The bank isn't predicting central bank buying. They're facilitating it and profiting from every transaction. Shearer stated explicitly that diversification away from United States dollar reserve holdings, while still moderate, has been accelerating. Even with 3 consecutive years of more than 1,000 tons of central bank purchases, the structural trend has further to run in 2025 and 2026. And here's the mathematical certainty behind JPMorgan's positioning. Every 100 tons of quarterly increase in holdings from investors and central banks is worth around a 2% quarterly increase in the price of gold. With break-even demand around 350 tons, the projected 710 tons of quarterly demand from investors and central banks creates significant upward price pressure. JPMorgan isn't gambling on sentiment. They're calculating mathematical probabilities based on documented flows from the largest, most price-insensitive buyers on the planet. The rate cut. Timing that crystallizes everything. 2 days ago, December 10th, the Federal Reserve delivered its third consecutive 25 basis point rate cut, bringing the federal funds target range down to 3.5 to 3.75%. Chairman Powell's commentary was parsed as relatively dovish, even as the committee guidance remained cautious. Markets immediately priced in the probability of 2 additional cuts in 2026, despite the Fed's projections suggesting only 1. Jobless claims rose more than expected to their highest level in over 2 months. The Fed announced it will purchase approximately $40 billion in short-term Treasury bills to ease money market strains, a measure that should cap short-term yields and support precious metals. Gold responded by rallying to near $4,338. Silver exploded past $63 to record highs, and JPMorgan's derivative positions moved deeper into profit. But here's what makes the timing critical. JPMorgan didn't position for this rate cut cycle. They positioned years ago for the entire monetary regime that this rate cut represents. The transition from emergency tightening back to accommodation, the recognition that debt levels prohibit sustained high rates, the structural reality that central banks globally are trapped between inflation management and debt sustainability. When rates decline, the opportunity cost of holding non-yielding assets like gold decreases. Real yields compress, dollar strength moderates. All of these dynamics benefit gold holders. And JPMorgan has been accumulating the largest concentrated position in gold derivatives in United States banking history specifically for this environment. The derivative position structure matters here. If JPMorgan were short gold through derivatives, as some historical analysis suggested during earlier suppression periods, the bank would be devastated by a $5,000 gold price. But current positioning suggests the opposite. The bank is positioned long, structurally, massively. That $65.4 billion in notional derivatives includes both long and short positions. But the net exposure appears to favor substantial upside from higher prices based on the bank's public forecasts and infrastructure investments. This is the ultimate tell. When a bank takes a public stance predicting 50% upside in a commodity, while simultaneously controlling 60% of the derivative market and building out physical custody infrastructure, they're not speculating. They're positioned and waiting for recognition. The de-dollarization accelerant. Nobody expected JPMorgan's most aggressive scenario goes far beyond $5,000. In May 2025, the bank's analysts published research showing that if just 0.5% of foreign-held United States assets reallocate to gold, prices could eventually reach $6,000 per ounce by 2028. The analysis warned directly. The recent period in financial markets has demonstrated that interest and trust in United States assets are already being questioned, and the United States is vulnerable to capital outflows. Suggestions from the administration of burden sharing by other countries that benefit from the dollar's status as a reserve currency have put foreign investors on notice. This is JPMorgan stating publicly what everyone knows privately. Dollar hegemony is being actively challenged, not through military conflict, through portfolio reallocation. Foreign central banks and sovereign wealth funds watching dollar weaponization, sanctions policy, and fiscal deterioration are quietly diversifying. Not dramatically, not all at once. Gradually, systematically, irreversibly. And the mathematical impact is staggering. That 0.5% reallocation translates to only 3% of total gold holdings globally. But because supply is constrained and annual mine production is relatively fixed, the additional demand impulse on a quarterly basis is immense. Small reallocations create massive price impacts. JPMorgan calculated this scenario explicitly and published it. That's not a warning. That's a roadmap. They're telling anyone paying attention exactly what's coming and why. And their derivative positioning proves they believe their own analysis. Natasha Canova, JPMorgan's commodity strategist, provided the longest-term price target in October 2025, during a period when gold was pulling back from record highs. Gold should be viewed on a multi-year horizon with a target of $6,000 an ounce by 2028. $6,000, that's 38% higher than current levels. That's a compound annual return of roughly 11% over 3 years. For a supposedly safe haven asset that mainstream analysis typically projects with low single-digit returns. And the bank's confidence in this target comes from observing 3 converging forces. First, continued central bank accumulation driven by de-dollarization. Second, ETF inflows accelerating as rates decline and real yields compress. Third, supply constraints as mine production struggles to keep pace with industrial and investment demand. Caneva stated the positioning clearly. It's just a very clean story. You have a lot of buyers and no sellers. That's the setup for explosive price discovery. That's the environment where paper markets break, where physical premiums explode, where inventory disappears from vaults faster than it can be replenished. And JPMorgan is positioned at the center of this dynamic with the largest derivative exposure, the biggest vault infrastructure, and the clearest view of real-time flows. When they publish a $6,000 target, they're not making a forecast. They're describing what they see coming based on flow data nobody else can access. The institutional playbook playing out. In real time, watch what JPMorgan does, not what they say publicly. The bank's actions over the past 5 years reveal a consistent pattern. Accumulate derivatives during consolidation. Build physical infrastructure during price advances. Publish cautious public commentary to prevent panic buying. Tell private clients the real outlook, position for structural repricing. This is the institutional playbook for front-running monetary regime change. It's not illegal. It's not manipulation. It's information advantage converted into position advantage. And right now, that advantage is crystallizing into extraordinary profits. Gold up 63% year to date. Silver up 105%. JPMorgan's derivative book moving deeper into profit on both metals. Custody fees exploding as ETF holdings grow. Vault utilization at peak capacity generating premium pricing. Transaction fees surging during physical market volatility. Everything the bank positioned for over the past 5 years is happening simultaneously. The Fed cutting rates, central banks accelerating diversification, ETF inflows resuming, physical premiums expanding, technical breakouts confirming trend continuation. And the most telling detail? JPMorgan isn't reducing exposure. They're expanding infrastructure, building more vault capacity, hiring more precious metals professionals, deepening custody relationships with ETF sponsors, all the behaviors of an institution preparing for sustained, higher prices, not a cyclical top. The pattern that can't be hidden. December 12th, 2025. Gold near $4,300, silver at record highs above $64, and JPMorgan controlling 60% of United States gold derivatives while forecasting $5,000 gold by 2026 and $6,000 by 2028. This isn't a prediction, it's a position. The largest, most connected bank in precious metals is telling anyone willing to listen exactly what they see coming, not through press releases, through derivative accumulation, through vault expansion, through custody dominance, through forecasts published to private clients but not promoted to retail investors. The game is visible for those who look. Accumulate during consolidation. Position before recognition. Profit during acceleration. And JPMorgan has been playing this game for 5 years, while everyone else debated whether inflation was transitory. Now the Fed has cut rates 3 times. Now central banks are accelerating reserve diversification. Now ETF inflows are resuming. Now technical patterns confirm breakouts. Now everything the bank positioned for is happening. The question isn't whether JPMorgan's forecast is correct. The question is whether anyone else will recognize what is happening before the bank's $6,000 target becomes reality. Because when the largest institution in precious metals infrastructure builds the biggest derivatives position in history while expanding physical custody and publishing multi-year price targets 50% above current levels, they're not guessing. They're positioned. And they know something the rest of the market hasn't priced in yet.